Let me start with a question that sounds uncomfortable, but necessary if the system is stronger than ever. Why does it feel harder than ever to protect your savings? We are told inflation is cooling, markets are resilient, and policymakers have everything under control. Yet beneath that confidence lies a reality most people sense but cannot fully explain. Your money is not just losing value, it is increasingly trapped. And history warns us that when savings become trapped inside a fragile system, collapse is no longer a possibility. It becomes a timeline. In 1929, the collapse did not begin with panic. It began with confidence. People believed markets only moved upward, that new financial tools had eliminated risk, and that authorities could smooth out any downturn. Savings poured into banks and stocks because there seemed to be nowhere else to go. When the system cracked, access to money vanished almost overnight. Banks closed, withdrawals were frozen, and what people thought they owned became inaccessible at the exact moment they needed it most. Fast forward to today, and the pattern is eerily familiar, but more sophisticated. In 2026, the threat is not bank runs on street corners, it is silent restriction. Savings are now digital, centralized, and deeply tied to debt markets. Pension funds, money market accounts, insurance products, and even cash deposits are all linked to government bonds and leveraged financial instruments. On paper, your savings exist. In reality, they are locked inside a system that depends on constant stability to function. Here's the hook: most people miss. Collapses no longer arrive as sudden crashes. They arrive as slow traps. Inflation quietly erodes purchasing power. Withdrawal limits normalize. Emergency measures become permanent. In 1929, people lost access to their money because banks failed. In 2026, people risk losing access because the system cannot allow everyone to exit at once without imploding. That is a crucial difference and a far more dangerous one. Another uncomfortable truth is that debt has replaced growth as the engine of stability. In 1929, debt magnified losses. Today, debt is the foundation itself. Governments, corporations, and financial institutions cannot function without rolling over massive obligations. Your savings are used to support that structure, whether you realize it or not. When stress appears, protecting the system takes priority over protecting individual savers. History shows this clearly, even if modern language tries to hide it. What makes the 2026 risk more severe than 1929 is scale and control. In the past, money was physical, and escape routes existed. Today, capital controls, regulatory barriers, and policy interventions can be implemented instantly. The promise is stability. The cost is freedom of movement. When everyone believes their savings are safe, but cannot freely use them, confidence becomes the illusion that sustains the system. Until it doesn't, most people believe their savings exist as a separate, protected store of value, sitting quietly in an account until they choose to use it. That belief is comforting, but it is no longer accurate. In the modern financial system, savings are not isolated assets owned in full by the individual. They are active components of a much larger financial structure. The moment money is deposited into a bank, pension fund, or savings vehicle, it stops being idle capital and becomes system liquidity. It is lent, pledged, leveraged, and recycled across markets in ways that most savers never see and rarely question. Here is the critical hook: your savings are not waiting for you, they are working for the system. Banks do not store deposits in vaults, they transform them into loans, bond holdings, and derivatives exposure. Pension funds allocate contributions into government debt, corporate credit, and equity markets to meet return assumptions. Money market funds, often perceived as the safest option, rely heavily on short-term sovereign and institutional debt. This interconnection means that the value and accessibility of your savings are no longer determined by your personal financial discipline, but by the stability of the entire system. This structural shift marks a sharp departure from how savers intuitively understand ownership. While account balances show a clear number on a screen, the legal and functional reality is far more complex. Depositors are unsecured creditors of financial institutions. Their claims are only as strong as the institution's solvency and the system's willingness to honor withdrawals under stress. In calm periods, this distinction feels irrelevant. During disruption, it becomes decisive. Another uncomfortable hook is that diversification within the system does not equal independence from it. Many savers believe spreading assets across banks, funds, or retirement products reduces risk. In reality, these entities often hold the same underlying instruments, particularly sovereign debt. When stress hits one corner of the system, it propagates rapidly across all others. What appears as diversification is often just concentration in disguise. The deeper issue is that modern savings no longer represent stored past labor, they represent future system expectations. Governments rely on savers to absorb debt issuance. Financial institutions rely on deposits to maintain leverage. Markets rely on continuous inflows to sustain valuations. Your savings, therefore, are part of a circular dependency. The system needs them to remain in place, calm, and committed. Mass withdrawal or reallocation is not just inconvenient, it is destabilizing. This is why access to savings becomes conditional during periods of stress. Limits, delays, and regulatory controls are not policy failures, they are structural defenses. When savings are fully integrated into system mechanics, allowing unrestricted exits threatens the entire framework. The promise of safety is maintained as long as confidence holds. The moment confidence weakens, the true nature of savings as system-bound assets is revealed, often too late for those who assumed ownership meant control. Most people associate financial loss with visible events, market crashes, bank failures, or sudden account freezes. Inflation operates very differently, and that is precisely why it is so effective. It does not announce itself as a crisis. It presents itself as policy, as adjustment, as something temporary and manageable. Yet over time, it becomes one of the most powerful mechanisms for transferring wealth away from savers without ever requiring their consent. Here is the first hook most people miss. Inflation does not reduce the number in your account. It reduces what that number can command in the real world. Your balance remains intact, your statements look reassuring, and the system appears stable. But each year of elevated inflation quietly shrinks the real value of your past labor. The loss is invisible because it is distributed across time rather than delivered in a single moment of shock. This process benefits debtors disproportionately, especially governments. When inflation rises faster than interest paid on savings, the real burden of debt declines while the real value of savings deteriorates. This dynamic is not accidental. It is a structural feature of heavily indebted systems. Unlike taxation, which is politically visible and contested, inflation imposes its costs silently. Savers pay it automatically, often without recognizing it as a loss. Another critical hook is that inflation changes behavior before it changes outcomes. As purchasing power erodes, individuals are pushed away from saving and toward risk-taking. Cash feels unsafe, long-term planning feels pointless, and speculation begins to replace prudence. This is not a psychological side effect, it is an economic consequence. Inflation penalizes patience and rewards immediacy, reshaping the financial culture of an entire society. In contrast to 1929, where wealth destruction was abrupt and undeniable, today's losses are normalized. Price increases are explained away as supply issues, geopolitical shocks, or transitional phases. Over time, these explanations lose relevance, but the damage accumulates. What would have triggered outrage in a deflationary era becomes accepted as the new baseline. The saver adjusts expectations downward, often without realizing how far they have fallen behind. The most dangerous hook is that inflation disguises financial repression as stability. Low real interest rates are framed as supportive policy. Currency debasement is justified as economic management. Meanwhile, the saver is trapped in assets that cannot keep pace with rising costs. Exiting into alternatives often requires taking on higher risk or navigating regulatory barriers, reinforcing the cycle. Inflation, in this sense, is not merely an economic condition. It is a redistribution mechanism embedded in policy choices. It allows systems under strain to function longer than they otherwise could by drawing steadily from the purchasing power of savers. Because the process is gradual and impersonal, resistance is rare. By the time the impact becomes obvious, the transfer has already occurred quietly, efficiently, and largely unnoticed. Liquidity is often described as a basic feature of modern finance, almost a promise built into every account balance. You are told your money is available on demand, transferable at will, and secure by design. That assurance feels absolute in normal times, which is precisely why it is rarely questioned. Yet liquidity is not a permanent right. It is a conditional state that exists only as long as the system remains orderly and confident. Here is the first hook that challenges the assumption of control. Liquidity is granted, not guaranteed. Financial institutions operate on the expectation that not everyone will demand access at the same time. Deposits are transformed into long, dated assets, while markets rely on continuous rollover of funding. As long as confidence holds, this mismatch remains invisible. When stress emerges, the illusion of instant access begins to fracture. Unlike 1929, where bank doors physically closed, modern liquidity constraints are far more subtle. Transfers slow, settlement windows widen, withdrawal limits appear, and regulatory guidance quietly shifts behavior. These measures are presented as safeguards, not restrictions, yet their effect is the same. Access to funds becomes conditional on policy approval and systemic stability rather than individual ownership. Another critical hook is that digital finance accelerates control while reducing transparency. With centralized clearing systems and real-time monitoring, authorities can intervene instantly to preserve order. While this capability is framed as progress, it also means that liquidity can be restricted with unprecedented speed and coordination. There is no need for panic or visible failure. Access can be modulated quietly, legally and temporarily until temporary becomes normalized. Market-based liquidity is even more fragile. Assets assumed to be liquid often depend on active buyers and stable pricing. During stress bid-ask spreads widen, redemptions are gated, and funds suspend withdrawals to avoid forced selling. The saver learns, often too late, that liquidity exists only when others are willing and able to absorb the exit. When everyone seeks the door simultaneously, the door narrows. The deeper issue is that modern systems cannot allow unrestricted liquidity under pressure without risking collapse. High leverage, interconnected balance sheets, and debt-dependent stability require controlled exits. If all savers could instantly access and redeploy their funds, asset prices would fall sharply, funding markets would seize, and institutional solvency would be threatened. Restrictions, therefore, are not anomalies, they are built-in defenses. The most unsettling hook is that conditional liquidity changes the meaning of safety. Stability is preserved by limiting movement, not by honoring access. Savers are encouraged to remain calm, trust the process, and avoid actions that might disrupt markets. In that moment, liquidity ceases to be a feature of ownership and becomes a tool of system management. What appears as protection is, in reality, a reminder that access exists only as long as it does not challenge the structure itself. The modern financial system is often presented as flexible, adaptive, and supported by a wide range of policy tools. Interest rates can be adjusted, liquidity can be injected, and markets can be stabilized when stress appears. That narrative sounds reassuring, but it conceals a structural constraint that did not exist on today's scale in earlier eras. Debt saturation has quietly removed the option of true normalization, leaving policymakers with fewer choices than they are willing to admit. Here is the first hook that reframes the risk. The problem is no longer excessive debt during a cycle, but debt as the cycle itself. Governments, corporations, and financial institutions are no longer managing debt on the margins. They are dependent on continuous refinancing to remain functional. Even modest increases in borrowing costs threaten fiscal balances, corporate solvency, and market valuations. This transforms policy from a tool of correction into a tool of survival. In 1929, excess leverage magnified losses after the collapse began. Today, leverage defines the system before any collapse occurs. Public debt levels require constant market absorption. Corporate structures rely on cheap credit to sustain buybacks, expansion, and even basic operations. Financial institutions hold vast quantities of sovereign bonds as risk-free assets, making government solvency inseparable from financial stability. This interconnectedness severely limits the ability to raise rates, reduce balance sheets, or allow natural deleveraging. Another critical hook is that policy credibility now depends on avoiding pain rather than confronting it. Normalization would require allowing defaults, asset repricing, and fiscal discipline to reassert themselves. Yet each of these outcomes threatens employment, pensions, and political stability. As a result, policymakers are incentivized to delay adjustment, choosing financial repression over correction. Low real rates, regulatory support, and central bank backstops become permanent features rather than temporary responses. For savers, this shift carries a hidden cost. When debt sustainability becomes the priority, protecting purchasing power becomes secondary. Interest rates are held below inflation to reduce the real value of outstanding obligations. Savings are pushed into riskier assets to compensate for suppressed returns. What appears as supportive policy is, in effect, a transfer from those who save to those who borrow at scale. The most revealing hook is that every policy option now creates a trade-off that did not previously exist. Raising rates risks widespread defaults. Cutting rates fuels inflation and asset distortion. Fiscal restraint threatens social stability. Expansion increases dependency. With debt saturation, There is no clean path forward, only managed outcomes. In that environment, policy does not aim to restore balance, it aims to buy time. Debt saturation does not cause immediate collapse. It creates fragility that must be constantly managed. The system survives not because it is strong, but because it cannot afford to fail. And in such systems, the interests of savers are inevitably subordinated to the imperative of keeping the structure intact, regardless of the long-term cost. Modern financial systems are often analyzed through data, ratios, and economic indicators, yet their true foundation is far less technical. They are sustained by confidence. Prices, currencies, and savings instruments hold value not solely because of underlying fundamentals, but because participants collectively believe they will continue to do so. This belief functions as a stabilizing force, but it is also a point of vulnerability that becomes critical during periods of stress. Here is the first hook that challenges conventional thinking. Confidence does not reflect strength, it substitutes for it. When growth is robust and balance sheets are healthy, confidence is reinforced by reality. When growth weakens and debt expands, confidence becomes a requirement rather than a byproduct. Markets continue to function not because fundamentals justify valuations, but because participants expect support, intervention, and continuity. This dynamic was present in 1929, but it operates on a far greater scale today. Asset prices are elevated not simply by earnings or productivity, but by expectations of policy response. Central banks are assumed to intervene during downturns. Governments are expected to protect markets deemed systemically important. This expectation compresses risk perception and encourages behavior that would not exist in a fundamentals-driven environment. Another critical hook is that confidence is self-reinforcing until it suddenly isn't. As long as belief holds, imbalances can grow without consequence. Asset prices detach further from underlying cash flows. Debt expands faster than income. Savings chase yield in increasingly complex instruments. Each cycle reinforces the assumption that stability is permanent. The longer this persists, the more fragile the system becomes. When confidence begins to weaken, the adjustment is rarely gradual. Fundamentals reassert themselves faster than policy can respond. Liquidity dries up, correlations converge, and assets once considered defensive move in the same direction. At that stage, reassurance loses effectiveness. Statements, forecasts, and emergency measures fail to restore belief because the underlying imbalance has already been exposed. The most dangerous hook is that confidence can be mistaken for control. Authorities may appear capable of managing outcomes through communication and intervention, but their influence depends entirely on trust. Once participants question the limits of that influence, behavior shifts rapidly. Capital preservation replaces return seeking. Access replaces yield. Certainty replaces optimism. In such moments, savers discover that confidence was the unseen asset supporting their financial security. When it weakens, no policy tool can fully replace it. Fundamentals matter again, but by the time they do, valuations and assumptions must adjust. The system does not break because confidence disappears. Confidence disappears because the system can no longer sustain the story that supported it. In past financial crises, collapse was defined by speed and visibility. Markets crashed, banks failed, and the damage was immediate and undeniable. What distinguishes the modern risk environment is not the absence of collapse, but the transformation of how it unfolds. Today's systems are designed to prevent sudden exits, not sudden losses. This shift changes the nature of financial stress from an event into a condition. Here is the first hook that reframes modern crises. The danger is not being wrong about markets, it is being unable to leave them. Capital once flowed freely in and out of assets. Today, that freedom is increasingly constrained by structure, regulation, and design. Digital finance, centralized clearing, and compliance frameworks have created efficiency, but they have also narrowed the number of independent exit paths available to savers. In 1929, wealth destruction occurred because prices collapsed. In the modern environment, wealth is often preserved on paper while access is restricted in practice. Redemption gates, settlement delays, capital controls, and policy directives limit the ability to reposition savings when conditions deteriorate. These measures are presented as temporary and protective, yet their recurrence suggests they are becoming standard features of system management. Another critical hook is that exits are constrained precisely because they work. If large numbers of savers were able to reallocate capital simultaneously, asset prices would adjust violently and funding markets would seize. Modern systems cannot tolerate that adjustment without threatening institutional solvency. As a result, friction is deliberately introduced into exit mechanisms to slow movement and preserve stability, even at the expense of individual flexibility. This creates a new form of financial risk-time risk. Instead of losing value instantly, savers lose optionality over time. Capital remains invested in underperforming or inflation-exposed assets because alternatives are inaccessible or regulated. The loss is not dramatic, but it is persistent. Wealth erodes not through collapse, but through prolonged stagnation and constrained choice. The most revealing hook is that restricted exits redefine ownership. Holding an asset no longer guarantees the ability to convert it when needed. Control is conditional on system tolerance, not personal decision. Safety is measured by compliance rather than autonomy. Savers are encouraged to trust the structure, remain patient, and accept limits as necessary for the greater good. In this environment, collapses do not announce themselves with headlines. They unfold quietly through rules, delays, and normalization of restriction. The absence of panic is mistaken for stability, even as flexibility disappears. Modern financial systems do not fail by breaking. They fail by closing doors slowly enough that most people do not notice until movement is no longer possible. So what is the real lesson from comparing 1929 to 2026? It is not that collapse must happen tomorrow. It is that systems fail when trust outruns reality. When savers are encouraged to stay calm while structural risks quietly grow, history is already speaking. The question is not whether wealth can disappear. The question is how quietly it can be restricted before people realize what has changed.